everyone, and welcome to this session of the AIC that will focus on New Zealand's experience with macro-prudential mortgage tools. Grant Spencer needs little introduction to the AIC, given his appearance at this conference in past years. Many of you will also have heard him speak at yesterday's central bank panel with RBA Governor Stevens and Fed President James Bullard. Given the fairly short space of time that we have available today, I'll keep the biographical details somewhat short, but it would be remiss of me not to run through some of the key points. Grant Spencer was appointed Deputy Governor and Head of Financial Stability at the RBNZ in February of 2007, and he took up his role in April 2007. The Financial Stability Department is responsible for formulating and implementing public policy to promote and maintain a sound and effective financial system. Its major functions include foreign reserves, domestic liquidity management, analysis of financial markets and institutions, and developing and implementing public policy regarding financial institutions. Prior to his current position, Grant was Assistant Governor and Head of Economics at the Reserve Bank from 2004 to 2007. Before that, Grant worked at the ANZ Banking Group from 1995 to 2004 in various senior roles, including New Zealand Treasurer and Head of Strategy and Business Development. Prior to joining ANZ, Grant held other senior roles within the Reserve Bank in the financial markets and economics departments. He also worked as a special advisor with the International Monetary Fund. Grant has spent time as a non-executive director of the New Zealand Institute of Economic Research, a council member and vice president of the New Zealand Association of Economists, and a council member of the New Zealand Corporate Treasurers Association. Grant holds a BA in Economics Honours and Information Science from Victoria University and an MSc in Econometrics and Mathematical Economics from the London School of Economics and Political Science. As most of you will know, in recent months, Grant has spent much of his time crafting the RBNZ's new macro-prudential policy on housing that was successfully implemented in New Zealand in October of last year. I'm delighted that Grant has agreed to talk to us today about the Reserve Bank's recent experience in this area, and please join me in welcoming Grant to the podium.
Thanks very much, Sean, and thanks to you all for coming along. This topic, coordination of monetary policy and macro-prudential, sounds pretty esoteric, pretty academic, but actually, you know, it's quite current. It's quite relevant to current policy right now, because there's been a lot of macro-prudential policies introduced since the GFC. There's been a lot of talk about it. And macro-prudential, as you know, is prudential policy that's aimed to lean against emerging systemic risks, particularly from asset price cycles. So macro-prudential policy is a policy that you're going to be putting on and off through the cycle. So with these, that then asks the question about timing and about the timing relative to monetary policy. So you naturally get this question about coordination with monetary policy. And particularly in New Zealand at present, you know, we introduced loan-to-value ratios last year in October, restrictions on high LVR lending on residential mortgages. And then more recently, just 2 weeks ago, we increased the OCR by 25 points. So we're the first monetary policy tightening that we've had for several years, really since rates have been low since the GFC. So we have the situation now where we have a macro-prudential tool in place and we're starting to tighten monetary policy. So again, the question is, how do we coordinate these policies? How do we manage them jointly? That's not an issue that we've had before because we didn't have the macro-prudential tool operational in previous monetary policy cycles. So let's think about what the case for coordination. Now this is a diagram of monetary policy working through interest rates to price stability, and down here we have macro-prudential policy working through bank balance sheets to financial stability. Now, the basic point here is there are crossover effects. If the macro-prudential policy worked to financial stability independently of this transmission here, then you wouldn't have to worry about coordination. Each policy arm would just get on with its job. But of course we know that macro-prudential has an impact on balance sheets, which affects credit, quantity of credit, it affects spreads, costs of funds, which then in turn affects the other objective. And similarly in the other direction. So when you have these crossover effects between two policy arms, there's a basic case for coordination, a prima facie case. But then you have to ask the question, well, when are you going to coordinate? And to what extent? How active is that going to be? And that really comes to think about that, you have to think about the cycles. Because macro-prudential is responding to the financial cycle, right? Tending to respond to asset prices. Monetary policy is responding to the real cycle, excess demand or the output gap. And those two cycles, the real cycle and the financial cycle, don't always work together. Sometimes they're in sync, sometimes they're out of sync. Now, this basically says if inflation pressure here and asset market pressure here, if one of the policies sort of is a neutral, then it's not a big issue because you can basically run the policies independently. If they are in sync and moving together, so for example you have a strong inflation pressure and also strong asset market pressure, then the policies are going to be complementary because they're going to be tending to work in the same direction. And then you have a coordination issue there, but it's a reasonably easy issue because the two policies are helping each other. The trickier situation comes when those two cycles are out of sync. And for example, where you have weak inflation pressure but strong asset markets. And then you have a potential for conflict. So when you're out of sync, there or the opposite down here, that's when it gets tricky, but it's still important to try and coordinate. That's when you're going to have a lot of discussions about what the relative weight of the two objectives is. And just to sort of put a bit of reality around it, this situation probably is similar to what you're seeing in the US at present. In the US at present, and we talked about this yesterday at the panel with Jim Bullard, inflation is still low in the US, right? 1%. But asset prices are going up. Housing's not a huge issue in the US, but equities have been very strong, as you all know. And so you've got some exuberance in asset markets, but weak inflation conditions, high unemployment, unemployment still relatively high. So what's the coordination issue there? The key issue that they're debating is to what extent should monetary policy be helping financial stability? To what extent should you be tapering faster to start to lean against asset markets before you wind up with a financial stability issue and repeat the mistake that we had in the last boom? So this is the sort of question that people are asking. So I just now want to ask, what can macro-prudential do for monetary policy, and then vice versa, the other question. In the first question, what can Macro-Prudential do for price stability? I think my main point here really is that it can't do as much as in the other direction. Macro-Prudential is not a strong policy. Its monetary policy is stronger in terms of just the relative weight of effect. In other words, if you've got a rampant asset markets, Macro-Prudential is not going to stop them dead. Monetary policy potentially can if you tighten enough. So Macro-Prudential, is a useful tool, but don't oversell it, is I think the key point. It can be useful for targeting hot spots because it's, for example, in New Zealand where we've had pretty benign inflation pressures up until recently, but the housing market was getting away. So housing market was presenting issues for financial stability. So Macro-Prudential was relevant for targeting that hotspot and giving some support as it was doing so to lean against emerging inflation pressures. So while we started to tighten monetary policy 2 weeks ago, if we hadn't had the LVR restrictions at Macro-Prudential last October, maybe we would have had to start tightening a bit sooner. So in that sense, it may have taken some of the exchange rate pressure off the New Zealand dollar. Even though, as we know, the Kiwi is still very strong, but potentially it may have been even stronger if we didn't have the Macro-Prudential policy. The other one is in the downward cycle. If monetary policy is having to ease when the cycle is going down, if Macro-Prudential does some of that work, it may be less likely to hit the zero lower bound, which obviously has been a big issue for a number of countries since 2008. So Macro-Prudential can potentially help in that regard. But the key issue is to remember that you can't push it too far. If you push Macro-Prudential too far, there's a risk of spillover effects, of disintermediation, of putting such a burden on the banking system that the funds flow around the banking system through the shadow banking system, which is an inefficient form of intermediation and then would potentially undermine the policy that you're trying to achieve in the first place. So don't push it too hard. Now, what about on the other side? What's the extent that monetary policy can help financial stability? And this comes back to the US type situation at present. And I think really, monetary policy can do quite a lot. Monetary policy can do a lot to lean against asset markets if it puts its mind to it. And particularly, of course, if it's consistent with the price stability objective. So monetary policy is the more powerful side of the equation when you're talking about this coordination issue. Also, of course, monetary policy can do damage to financial stability. So it can help, but it can also do damage if, for example, rates are kept at very low levels for a very long time. That can set up asset price bubbles that can generate financial instability. Also, very sharp, large increases in interest rates can be adverse for financial stability and cause bank failures, etc. But the key here for monetary policy is it should not be diverted from its main purpose. If you push it away from price stability too far, then you potentially lose the credibility, the hard-won credibility of an inflation-fighting central bank. So you can potentially use monetary policy to divert for a little bit, but don't take it away too far from its prime purpose. Now, coming back again, I think to the US situation, how far you go with monetary policy and helping financial stability, there's been this debate around it, sort of summarised as the clean versus lean debate. The clean is really clean up. So that's the idea, is when you have an asset price boom, and remember this was the Greenspan sort of doctrine, and also Bernanke, this is Bernanke's approach. You don't use monetary policy to lean against a housing market boom or a stock market boom. But then if and when the bubble bursts, then you help to use monetary policy to help clean up the mess, hence the clean up after the bubbles burst. The other theory is you lean against it. So this is the lean against the boom with monetary policy. So the clean approach, again, is a sort of the Federal Reserve approach, which I think is still identified with the Fed and their approach. They say, let prudential policy look after financial stability, and we'll just keep monetary policy focused on the real economy and price stability. This lean against the cycle approach is commonly identified with the BIS. A lot of research from the BIS over the years has been around promoting a greater role for financial stability in monetary policy. And more recently, and this is what Jim Bullard was talking about this yesterday, Jeremy Stein, who's now one of the governors on the Fed, he's a proponent of leaning more against asset market bubbles. And he wrote, there was a speech he put out just recently. And Jim Bullard is also more in that camp, I believe. And hence, those two will tend to have, in the spread of Fed governors, and when they think tapering is going to finish, you're going to have interest rate increases, they tend to be the high ones, because they're the ones who think tapering should go faster, it should move more quickly back to a normalisation. They're more in this camp than in this camp. And I would say that generally, notwithstanding maybe the Fed is still sort of Bernanke influenced, this is sort of where things are headed, generally, globally, is towards an approach where monetary policy does play a greater role in terms of leaning against asset markets, asset bubbles, and promoting financial stability. And so I'm terming this in my paper sort of conditional coordination. This model where each policy stays primarily focused on its main target, but can assist the other policy as long as it doesn't divert too far from its own target. And this essentially is, I would say, the framework that we have in New Zealand at present, where monetary policy, the mandate is governed by the PTA, the Policy Targets Agreement. The primary objective is price stability, but we should also have regard, monetary policy should have regard to financial stability. On Macro-Prudential, the mandate, which is under our MOU that we signed last year with Bill English, has financial stability as the primary objective, but we should have regard to the interaction with monetary policy, which means we should have regard to, effectively, price stability. The decision making, in monetary policy we have independence. The governor makes the call, or now it's the governing committee which is making that decision, and the decision is made independently from government. The difference on the other side with Macro-Prudential is that under the MOU, we consult with the Minister, we consult with Treasury, we consult with the banks before we do something, and the decision making is still finally by the Governing Committee of the Reserve Bank. And finally, I'll just mention the actual policies in place, our LVR restrictions and monetary policy. The LVR limits that were put in on October last year, so we've had about nearly 6 months since they were put in. Definitely high LVRs drop down below the 10% limit, so all the banks have made sure they comply with the policy. We think we've had an impact on the housing market where house sales since October, 1st of October, have reduced by 13%, and we think with a sort of counterfactual analysis that house prices overall are about 2% lower than they would otherwise have been, using sort of econometric modelling to try and estimate that. And overall, house price inflation in New Zealand is down from about 10% to about 8%. Credit hasn't fallen as much, credit growth, but is down somewhat. So we think that the LVR impact overall on CPI is worth about 25 to 50 basis points on the OCR as an approximation. And as I said, given that has done some of that work and does not have the same impact on the exchange rate as an OCR increase, we think there may have been some benefit in that regard. And then on the other side, monetary policy. This is our graph of the 90-day interest rate. This is where we were in 2008, dropped down, a slight bump here, but otherwise has been pretty flat at 2.5%. 2 weeks ago, we increased it by 25 points, and we're expecting about another couple of hundred points over the next 2 years, given the conditions that we see today. Now, this is, it's not targeted at financial stability. The main objective, we went through the analysis to determine the change in policy, is basically driven by inflation pressures. Because we've got the Christchurch rebuilding the second biggest city in New Zealand, which is really taking off now, the rebuild activity, after many years of planning and squabbling around insurance claims, etc. We've got terms of trade which is at record levels, and milk prices have increased 40% in the past year. And we've also had the strong housing market leading to sort of wealth effects, spending effects. So this monetary policy is a response to those projected inflation pressures. But at the same time, it has the benefit of reducing the risk of financial stability by slowing down housing as interest rates increase. So the further we go up this curve, as interest rates increase, we'll then have a greater opportunity to take the LVRs off, because then there won't be a situation where we take the LVRs off and housing comes flying back up, defeating the original purpose of the policy. So this is one of the factors that we have to take into account when we're thinking about when and how to remove the LVR restrictions. So just summarising, we're essentially proposing that this coordination should be conditional policy coordination. It is sensible to coordinate monetary policy and macro-prudential, but the primary objectives of these policies should be kept clear, must be kept clear. Monetary policy targets price stability, macro-prudential targets financial stability. and excessive deviation in support of the secondary objective can be damaging. So you have to keep your eye on the main game, but help out the other policy when the conditions are right. So I'll leave it there, Sean, and if there are any questions, then I'd be happy to try and answer them.
Do you want to sit back down, Grant? Might be more comfortable.
Yep.
Okay, so thank you, Grant, for the presentation, for explaining the use of Macro-Prudential. We will throw this open to the floor for Q&A, but perhaps I'll kick off and use my prerogative to ask the first question here. I'm interested, Grant, in how immediate the effects of the limitations on high LVR lending have been in the last few months since the bank brought in the new policies. The RBNZ gave the banks a maximum 10% speed limit on their lending, plus an additional 5% allowance for other types of very specific loans. The most recent numbers, I think, which came out yesterday, show that the high LVR numbers are running closer to 5%. So there's a considerable gap between what the RBNZ has permitted and what the banks are actually lending. Why do you think this has happened, and is this causing a much faster market reaction than you predicted? And if so, would it be appropriate for the RBNZ to review those limits a little bit sooner?
I don't think it would be appropriate to review the number. I mean, what happened is the banks, we gave them 6 months to meet their 10% speed limit. So what they did is they had to manage down their high LVR lending to get an average over the 6 months that was less than 10%. So some of them were quite aggressive and just turned the pipeline off of pre-approvals. Others kept managing the pre-approvals and made a slower sort of transition. But most of them now have cleared the sort of backlog, the pipeline of loans, pre-approved loans. And I think, so at the margin they were stopping because they still had things coming through from prior approvals. I think now they've cleaned the pipeline out. Also, they have controls and processes in place that now make it easier for them to manage the front line. And so I think you will see that number drift back up towards 10%. I think most of them are probably targeting about 8% to still leave a bit of a buffer. Mm-hmm. So I think it's manageable, and we'll leave it where it is.
Okay. Just one additional one from me, then I will pass it on. Can I ask you a little bit about the quite narrow distributional effects and the consequences of macro-prudential policy, especially on first home buyers who are at the foot of the property ladder? The RBA and the papers that have been released fairly recently have indicated that they've got some concerns about the narrow effects that macro-prudential policy have, and they've chosen not to adopt, at this stage, the same policies as the RBNZ. Why do you think this is, and why is it an issue in Australia and it's not an issue in New Zealand?
Well, I'm not sure about the Australian issue. I mean, those papers from the RBA were obtained under official information, so they didn't really they weren't published papers, or it was just that was an opinion of one of the authors. But I mean, you're right. The policy does have distributional effects, and has, we knew that when we started that 40% of the high LVR lending prior to October was going to new first home buyers. So that was going to be a disproportionate effect. But essentially, the policy is aimed at reducing risk in the financial system. It just so happens that new home buyers are a riskier proposition than someone who's a 50-year-old that has more savings and can afford a bigger deposit. I mean, that's the reality. And so, that policy is going to have some distributional effect. But that's not our aim. We have to try and assess, well, we have an objective of financial stability, and it's going to affect some segments more or less than others. It's like monetary policy. If you put up interest rates, as we did 2 weeks ago, if you're an older person that has savings, it's actually, you're going to benefit them because they're going to get more interest on their savings. But if you're a first home buyer or a new home buyer that's got a huge debt, you're going to be hit harder. So it's, you have that with normal monetary policy as well.
Okay, thank you. We'll open it up now. Any questions from the floor? If you have a question, please raise your hand. We'll get a microphone to you, and perhaps state your name and where you're from.
Cass Burns from Brevin Howard. If you look at the Fed or the US cycle, lending standards were very easy before the financial crisis. And the first thing which happened after the financial crisis, that lending standards tightened dramatically, encouraged by policy. So essentially they seem to have just done exact opposite from what you're propagating. What are your sort of thoughts about that? And
what do you mean they've done the opposite of what?
In the sense of during a time of strong economic growth, they had very loose lending standards, and then once economic growth collapsed, the first thing is they dramatically tightened lending standards. That's
right. So the behaviour of the banks themselves tends to be pro-cyclical. So yeah, they're easing when things on the upside of the boom, and then when things come off, they tighten up. I mean, the classic case in Europe at present, where they still won't lend, and lending is still going backwards. So macro-prudential policy tries to be counter-cyclical, so it tries to offset that, but it will always tend to be more effective on the up cycle, because you can require banks to have tougher lending standards and to stop them easing lending standards on the up cycle. But on the down cycle, it is more difficult. On the down cycle, if a bank is pulling in and really tightening up, it's very hard for policy to say, no, you should ease your lending standards. So, macro-prudential, I mean, this is a good point, will tend to be more effective leaning against an asset boom than it will be trying to pull you out of the hole.
I'll sort of ask differently, given all the regular changes in the US, should we have a similar cycle? Do you think it would happen very differently? Do you think the new regulatory framework in the US would be much more effective dealing with that issue?
I'm not sure in the US. I mean, you have Dodd-Frank, you have the new Basel III policies that will be implemented in the US, whereas the previous boom, Basel II wasn't in place. So I think, the prudential standards will be tighter and are tighter now than they were. But is that going to be enough to prevent a recurrence, particularly if monetary policy is very easy for a long period of time? It may not be. And you never know where the next crisis is coming from. So the policies have been tightened up, the prudential policies have been tightened up, and there'll be greater buffers there against losses if there's a downturn, but you're not going to stop crises from ever happening again. Because the next crisis, you never know where it's coming from, and history doesn't change that much. But I think the other response, regulatory response in the US, is about the institutional response, and I don't think really there's been a huge change. There's still a lot of fragmentation in the US financial regulatory system. There was never the unification that a lot of people were calling for immediately after, when the GFC happened. I mean, the Fed is now, looking after the big banks, and time will tell how well they do that job.
Hello, good afternoon. Francesca Fornazzari from Goldman Sachs Asset Management. There have been some reports in the press that the Labour Party, if it were to win the elections, would want to alter the mandate of the RBNZ, perhaps to include bit more sensitivity towards the needs of exporters and just broaden the mandate more broadly. Could you please comment on that?
Well, I can't really comment on that because I haven't seen the policy. There's been a lot of comment in the media that the Labor policy may be moving in that direction, but we don't have anything of substance as yet to say, well, this is an alternative proposal. I guess all I can say is that from the point of view of the model I had up here, where we have price stability as the primary objective, that the bank is happy with that framework, particularly where we have a secondary objective of financial stability, and we also have a secondary objectives of stability in the exchange rate and interest rates. So, you know, what we do when we're targeting the achievement of price stability in the medium term, we're certainly having very close regard to the real economy and the transition to that. So, you know, we have to recognise it is flexible inflation targeting. Sometimes we move outside of the 1 to 3% band. It's not a rigid inflation targeting model.
So Grant, just let me follow up on that point. If the change in the RBNZ Act was to push the bank towards a more mixed model of inflation and growth, how much of a challenge do you think that would present in terms of persuading foreign investors in particular of the stability and the commitment of the New Zealand financial authorities into controlling inflation? We obviously have an external imbalance that we're continually fighting, and our inflation mandate and our inflation control has been a very attractive support for the country. If we were to dilute that, would you see that being a significant impact?
Well, we're getting into the hypothetical situations now. It's very hard to make these sort of guesses, but clearly, whatever the structure is, we'll be following a responsible policy and ensuring to the best of our ability stability in the New Zealand economy in all its aspects.
Thank you, Grant.
Rob Stewart, Credit Suisse. If I could just follow on from that question, I think in monetary policy, is the rule book changing? Because you've got a number of jurisdictions where they're doing things that I would describe as less conventional. And New Zealand is one of the places where the rule book is the same and pursuing very conventional monetary policy. You know, does that, you know, the political pressure to, you know, comes to bear to think about things a little more differently? Does the rule book need to change in any way, shape or form as you look over a longer period of time, particularly when you see what's happening elsewhere in the world?
Well, this was one of the questions at the panel yesterday, and my answer, and I think it was similar to James Bullard, is that you know, monetary policy fundamentally hasn't changed, even though you've had quantitative easing and now tapering. So there's been a lot of unusual operations, and as a result of hitting the zero lower bound globally. But once we normalise, I think, you know, we're back to monetary policy regimes that haven't fundamentally changed. The one thing that I think is a more permanent change in terms of our monetary policy and globally is this attention to financial stability. That monetary policy authorities going forward will tend to think harder about financial stability and the implications of what they're doing for risks and emerging risks and how they should be responding to that.
David Fair from First NZ Capital. Just be interested in your comments. You spoke briefly before about the rebuild in Christchurch gaining momentum. We had the RBA governor yesterday talk about the pending residential construction boom in Australia. And I'm just interested in your thoughts on, how that might play out in the context of New Zealand in terms of, capacity constraints within the system, inflation in the system. Thank you.
Yes, well, that's certainly one of the things we've been thinking about very closely, and in the context of our monetary policy tightening cycle, because that's where a lot of the inflation risk is in the New Zealand economy at present. Christchurch construction costs in Christchurch are running at like 10 to 12% per annum. So they've been going up very steeply to attract those resources into Christchurch. Now that's starting to pull up construction costs in the New Zealand economy more generally, particularly also in Auckland, because there's this housing shortage in Auckland, so the building activity is rampant now, both in Christchurch and in Auckland. So that's where that pressure's coming on. Now, it hasn't as yet spread through to wage costs more broadly, but that's the risk, and that'll be one of the key factors that will influence the extent to which we increase interest rates over the coming 2 years, the extent to which inflation pressures actually show themselves and require a policy response. So, a lot of those resources are coming from offshore. Of course, there's a lot of Kiwis coming back from Australia with the downturn of the mining investment boom, but we're also having labour resources from Ireland and from Asia as well, such as the Philippines, for example. So there's a lot of resources coming in, and the more we see that, then the less pressure there'll be in terms of inflation pressure. So it's a bit of an unknown situation, unprecedented situation.
And I guess maybe if you just also add to that a little bit in terms of your thinking around the behaviour of the Australian banks, which are clearly dominant in the New Zealand marketplace, in terms of their lending behaviour, as we've seen in the past when things go quiet in Australia, all of a sudden everyone can get a cheap mortgage in New Zealand, and with a potential boom in Australia ahead of them, how that might impact their behaviour in the New Zealand mortgage market, as we've seen it before with the the loans and lending to the farming rural market.
Well, the banks, okay, the major Australian banks all have New Zealand subsidiaries that dominate the New Zealand system, but they actually operate reasonably independently, and the parents hold equity in the sub, but there's not actually a lot of lending support from the parents to the sub. So the New Zealand subs are self-funding. So they're funding from domestic resources, retail deposits, commercial deposits, and then raising funds wholesale offshore, and they're going to the market direct to do that funding. And at present, there's adequate funding. There's plenty of funding because savings have improved in New Zealand just as they have in Australia. So both the Australian and New Zealand banks are not having to really attack the offshore funding markets as yet. And then even if the pressure comes on, the parent and subs operate pretty independently. And I haven't detected in my time being a sort of a substitution situation where strong growth in Australia reduces resources for lending in New Zealand, for example.
Grant, I'm conscious of the clock ticking down. I'd like to ask you a question, if I can, about the currency and how it's currently fitting into the RBNZ internal policy debate. The current economic cycle in New Zealand is somewhat unusual in that the New Zealand dollar does not appear to be playing the traditional restraining influence at this stage of the cycle that we've seen in the past. Why do you think this is? And has the Reserve Bank's thinking about the currency and the level of the TWI been forced to change because of recent experience?
Well, you know, the strong currency is certainly having price effects. And so if you decompose our inflation between non-traded inflation and traded is still sort of close to zero, whereas non-traded inflation is close to 3%. So it's still having an important influence on inflation. But what you're saying is more related to, say, exports. And I mean, you're right that the New Zealand exporting sector has, to some extent, adjusted to high exchange rates, you know, how to live with a high exchange rate, because we've had a high exchange rate for many years. I mean, clearly the dairy sector, the exchange rate pressure is offset just by very high prices in foreign dollars. And so the agricultural sector more broadly, who are benefiting from the high export prices, the high currency is just bringing their incomes back to more normal levels in New Zealand dollars, but they're still making very good incomes in New Zealand dollars. Also, of course, with a lot of the manufacturing exporters export to Australia, where the cross with Australia, because the Aussie had been high, along with the Kiwi, then again the high trade-weighted index hadn't had the same impact on the manufacturing exporters. More recently, with the Aussie coming off relative to the Kiwi, then that is, you know, biting more with the manufactured exporters. But even then, that whole sector has adjusted structurally to be much more value-added, with a lot of the basic manufacturing components being done in China, etc. So there has been an adjustment.
Thank you. I think we've got time for perhaps one more question from the floor if there is one.
Hi, this is Chris Lee from ANC. So the demand from new immigrants has driven the housing price up, is one of the factors. So some countries like Canada, they choose to strengthen their immigration policy, while other countries like Hong Kong, they try to impose some kind of restriction over the buyers from outside. So can you comment on your policy how to cope with the situation?
Well, you're right that migration flows have really picked up over, really in the past 6 to 8 months have picked up. So the permanent long-term migration is now running at sort of 35,000 or so. It's actually getting up to similar levels to what we saw back in 02-03, which was the peak. And yes, that does put pressure on the housing market. So we're leaning against the housing market pressures with the LVR restrictions, with higher interest rates, and also with the building supply coming on. That's helping as well. But the thing that is working to support housing right now is the immigration factor. We don't, policies, you know, the migration policies change from time to time. We don't, the Reserve Bank doesn't have an influence on those policies, and we don't try to suggest that that policy should be managed, certainly in a cyclical fashion, because you're just getting the changes through for one cycle and it goes back and you wind up being pro-cyclical. So it's best to get a sensible migration policy and keep to it and keep it stable. We don't have some of the restrictions on foreign investment that, say, the Australians do. For example, in Australia, non-resident can only buy off the plan, for example. We don't have some of those restrictions. And the government may potentially look at some of those type of policies if the effect becomes particularly strong. But there's nothing planned in that direction at this point.
Okay, that's all we have time for today. I'd like to thank all of you for attending. I'd also like to thank Grant for agreeing to participate in yesterday's panel and for today's address and attending the AIC. Please join me in thanking Grant Spencer.
Thanks.